think true diversification means picking 50 different individual stocks and crossing your fingers? Wrong. That's not a diversified portfolio. That's just a chaotic, risky mess. If all your money is sitting in just one type of investment, like individual stocks, a single market crash can wipe you out. True wealth building isn't about collecting a bunch of random companies. It is about balancing entirely different categories of investments so that when one zigzags down, another zigs up. Today, I am giving you the ultimate blueprint to build a bulletproof 4-asset portfolio for 2026. Let's break it down. Asset number 1, domestic stocks. This is the growth engine of your portfolio. Over the last 125 years, equities have absolutely crushed other types of investments like bonds and cash. If you're looking at the global landscape, the US market is the undisputed heavyweight, making up about 62% of the total world equity market value today. When the economy is booming, these stocks are going to do the heavy lifting to grow your wealth and outpace inflation. But remember, to get those high returns, you have to accept that stocks will be volatile in the short term. Asset number 2, international stocks. Why not just put everything in your home country? Because financial data proves that the winning sector of the market changes constantly and it is incredibly hard to predict. Sometimes developed markets like Europe or Japan lead the pack, and other times emerging markets see massive bursts of growth. By owning international stocks, you cast a wider net. The research shows that investors who spread their money globally are generally better off and face less risk than those who only invest domestically. Asset number 3, total market bonds. If stocks are the engine, bonds are your brakes and shock absorbers. You don't buy bonds to get rich, you buy them to stay rich when the stock market panics. Historically, a portfolio mixed with 60% stocks and 40% bonds has never dropped by more than 50% during the worst global crisis since 1900. Bonds smooth out the wild roller coaster ride of the stock market, ensuring you don't lose your mind or your money during a major crash. Asset number 4, hard assets like gold and cash reserves. In the short run, cash is significantly less volatile than stocks, meaning you know exactly what your money is worth tomorrow. However, cash loses its purchasing power over time due to inflation. That is where a hard asset like gold comes in. While gold isn't a perfect magic shield against inflation every single year, over the very long term, its real purchasing power has multiplied by 5.2 times since 1900. Having cash and hard assets gives you a safety net to fall back on when everything else feels uncertain. So how do these 4 assets balance each other out during market chaos? It all comes down to a strategy called rebalancing. When the stock market crashes, your domestic and international stocks will drop, but your bonds will likely hold steady and your gold or cash might even gain value. Because you have a plan, you simply take a little bit of your safe money from bonds and cash and you use it to buy more stocks while they are dirt cheap. This 4-asset setup forces you to do the one thing most investors fail at: selling high and buying low. You get the massive growth of global stocks, the stable anchor of bonds, and the emergency safety net of cash and gold. Stop trying to pick individual winners. Build a balanced system, set it on autopilot, and let the math work for you. If you found this helpful, hit that subscribe button and I'll see you in the next video.